on Sky News Business. This is Trading Day, live.
Hi there, welcome back to the program. Just gone 3 o'clock in the east. As we make our way towards the close, about an hour or so left in today's session. At this point, looking like we're going to book a positive one, and certainly didn't look like that through the opening moves of the session this morning. We're up 10 points, 6,310. Certainly helping matters. CSL, take a look at that, up 4.7%, all-time high, yet again, $211.12.5 at the moment. Very impressive off the back of some very impressive numbers from them this morning. Also making news this afternoon, at least, Turkey to raise tariffs on some US imports, including cars, alcohol and tobacco. And no surprises really in today's wages growth. The wages index yearly up just the 2.1%, continuing to be nothing if not depressing. Let's take a look at the day's best and worst performers as we head towards the close. Avio looking like taking out the top spot at this point. Afterpay making a big surge towards the close, both up over 7%. Avio up almost 8% at the moment. Domino's, big return of serve following yesterday's movement. The volatility in this stock quite extraordinary. CSL, as we've discussed, and we're going to do more so shortly, a real standout session as well. And Seven West Media, ahead of their results in not too distant future, catching a bit of a bid at the moment, up 4 cents or just over 4% at the moment. So they're the best performers. Let's take a look at the worst performers. Pact Group at the moment, it continues to be by quite some margin, percentage-wise at least, the worst performer, down over 17.5%. Insurance Group has really been punished following their report out today. St Barbara, the gold player, Sandfire and Genworth as well, amongst the worst performers. Let's bring in Craig Sidney over at Shaw and Partners in Sydney. Can we start actually maybe with, we haven't spoken too much about the broader index, but the fact, Craig, it looks at this point like we're going to close above 6,300 with some room to move, relatively significant, seeing as it's been a bit of a hard stretch to do in the recent past, actually closing above it and holding above it.
Yeah, good afternoon, James. Yeah, we're sort of around that 6,300 level. So the last couple of times it's sort of gone close to that level. It's come back down around that 6,250. So it'd be interesting to see whether we can in fact break through that level. We do have index option expiry tomorrow, so the index is sort of going to sort of few investors out and traders out, given it's around that level. So it'd be interesting to see where that our market opens tomorrow on the back of what overseas markets do. You've got the Dow futures down about 50 points at the moment, but our market showing plenty of signs of resilience. I guess major movers today, CSL as you mentioned, but that's being offset. That's up about 13 points on the overall index, so it's quite substantial. CBA is offsetting that by about the same amount, but it's obviously trading ex-dividend today, so it's lost that $2.31 dividend, so offsetting each other there. But yeah, you mixed sectors today. Most of the oil stocks are down quite considerably. Woodside's one of the worst, and also Origin, Woodside on the back of its result. And then across the resource stocks, generally a bit of weakness across that space as well, as that iron ore price just sort of stabilises a bit at the moment. So not a lot of interest in resources, but certainly plenty of interest in the likes of CSL. Banks are pretty much strong across the board with the exception of CBA, and you've got Wesfarmers also pushing higher in that consumer staple section.
Yeah, I want to get to some of those individual report cards in just a moment, but it's interesting talking to some fund managers over the past couple of weeks who have been talking about taking on, whilst maintaining a level of exposure to equities, the nature of them becoming a little bit more defensive orientated. Your thoughts on portfolio positioning for clients at the moment, particularly when you look at a market that looks, well, it's above 6,300, looks relatively fully valued?
Yeah, we take the view that it does look pretty fully valued at the moment. I guess the overweight sectors that we're positioning ourselves in continue to be energy, so that includes the likes of Woodside. Still think that's got a strong balance sheet and growth potential there. But probably Santos there for leverage. Also don't mind Caltex. But across that resource space, BHP is probably our #1 pick there. It's got its result coming up, so it should have a reasonable result. And then there's the catalyst of the US shale asset sale, so that will create some form of capital management later in the year. So that should support the share price, not only short term but medium term. And also you've seen some weakness in Rio. It has gone ex-dividend, but it's dropped about $10 of recent, and it's still Fortescue. Does screen very well based on our valuations, but coming into a result, probably nothing too unexpected there, but just the concerns around that discount they're beginning on their iron ore, but balance sheet quite strong, cash flow very strong, so we'll see how that plays out. But those sort of stocks certainly look pretty good value. I guess banks across the board, CBA had a reasonable result. With some strength in the dividend, and you've also seen a rebound in some of the others. But yeah, we've got to buy on most of them, but some of them are starting to hit our target prices. So overall, generally think the market's relatively expensive.
So where do you sit with energy, in particular looking at a stock like Woodside? Sure's been, and rightly so, because energy's been a good trade, a good place to be for the good 12 to 18 months, or 12 months or so. Your thoughts on remaining long energy and Woodside in particular, courtesy of the half-yearly numbers this morning?
Yeah, I guess that they had their half-yearly. The net profit after tax come in at 560-odd million, broadly in line, slightly below, broadly in line with the market, slightly below our numbers. So we've dropped our numbers by about 8% for the full year. But we do see that there's continued growth expectations there. Senegal, there's oil exposure. Scarborough, they've got gas, and also Browse. Some of the areas where there's longer term growth. Balance sheet's in good shape. The debt at 30 June was just under $3 billion US, and the cash flow is very strong, and they're a low cost producer. So we think that's a pretty good place to have some money. The PE is not that demanding. It's about 14 times for next year, and the dividend is about 6% fully franked. So quite a high dividend yield. There's a fairly high payout ratio, but on a valuation basis, that one screens pretty well. Our target price there at the moment is $39, so just about $4 upside from current levels.
IAG, as we saw, amongst the worst performers, and it's very much been the case since it came online earlier this morning. Of course, the full year results. Did they warrant what we're seeing as far as the market reaction in your mind, Craig?
I guess with IAG, we have had a sell on the stock for quite some time, with a $7 price target. So it did screen pretty expensive, certainly compared to the likes of Suncorp. It's trading on a P of about 19 times, dividend yield of about 4%, and that's for next year. So it does screen relatively expensive to Suncorp, which is trading on a P of about 15 times and 5%. So we've certainly got a preference there for Suncorp, and certainly the market didn't take a liking to the IAG result today, because it was slightly below expectations, and their outlook in terms of margins was also slightly below expectations at around 17%, and their insurance premium growth, they're suggesting around 3%. So a couple of negatives coming out of their result. And the stock has been particularly strong. It's up about 15% for the year, the last 12 months. So hence it's no surprise it's being sold off about 7% today.
Meanwhile, alongside CSL, probably Wesfarmers garnering a lot of the attention and headlines. The stock's up at the moment about 3.25%, $52.22 and a half. Your thought on the numbers, and your thoughts at owning Wesfarmers at these sort of levels?
Yeah, look, firstly, their result up about 5% on the previous year, so quite a strong result. Coles had their like-for-like sales for the fourth quarter. They're around 1.8%, so that was sort of broadly in line with the market, which is expecting somewhere between 1.5 to 2, so that was actually quite good. We did see their EBIT margins fall from 3.9 to 3.7, so that's somewhat of a negative there. And also Bunnings, their like-for-like sales for the first half, they're at 7.8%. That's coming down from 9%. So although Bunnings has been very strong, you're starting to see a bit of a slowdown there. So that's somewhat of a negative. And they're still trying to sort out Target and Target, which it's improving, but it's still got a long way to go. And Kmart's doing pretty well. I think the sales, the numbers for the year up about 5.4%. In terms of pricing at this level, the P is about 20 times, dividend yield is about 4.2% for 19, so it's starting to look pretty expensive from our perspective. We've got a hold on the stock and the evaluation around that 46.25, so certainly one it's pretty hard to be buying at the moment. You might have a bit of interest coming into the dividend because they're paying out a $1.20 dividend, but certainly from a valuation perspective, starts to look relatively expensive. I guess they are looking to spin out Coles later in the year, so they may well re-rate the existing Wesfarmers business and actually give that a higher PE than what you'd expect from sort of a consumer staple company. But for us at the moment, looks relatively fully valued.
Okay, Craig Sidney, appreciate it as always. Thank you.
Okay, thanks, James.
And look, just while we're speaking about Wesfarmers, you can see an interview with the MD, Rob Scott, from 5:30 Eastern on the Tiki program. His thoughts, of course, on the numbers, but of course, as crucially, the outlook as well. Moving on, copper dropping to a 3-week low overnight. You saw Sandfire amongst the worst performers at the moment. Headway in wage talks between BHP and Escondida mine workers, though stemming fears a strike could curb supply. To talk more about this and where else he's watching as far as commodities are concerned, Markus Helsing from JP Markets joins us now from our Melbourne studio. Thanks very much for your time this afternoon. Copper, what to make of copper? Has it been overdone? Is there an opportunity in copper, or are you wary?
Hi, James. Now, look, we reckon we've entered the end game as far as the Goldilocks economy goes for the likes of Australia and many other commodity-related or dependent countries. But we still think the energy sector might drag here or there, but generally hold up better. We think anything that has to do with mining from here onwards is in trouble. We've got an emerging market problem that started already a few months ago into Turkey, and now is Turkey. There's a lot of talk already behind the scenes that some cracks might appear in China. So you've got to look at the underlying demand scenario in our view, and that's obviously China. Now, copper is, as we know, an excellent indicator for economic wealth or lack thereof for the whole globe, so to say, because you can't really manufacture much without copper. And the fundamental outlook, even with Escondida, we don't think that's going to be too much of a worry. In some ways, you never know, of course, but really the fundamental and technical picture looks rather awful. So, look, we're very bearish, and that has obviously in the moment multiple factors working on it. Not just the emerging world now starting to really struggle, to say the least. US dollar is just taking off like a rocket, and that's not helping either. So overall, we believe this could be, we believe this is the beginning of a major industrial commodity downturn, as Rio as a stock probably illustrates a lot better than BHP.
What about the precious metals, Marcus, which you've been particularly bullish on? I'm looking at gold, 1,187. I mean, how's that 3,000, 4,000 call?
Well, as you know, as Warren Buffett and people much smarter than me would say, a good investment takes a lot of endurance and a lot of patience. Now, we really feel that this is the final rally in the US dollar and most likely the final dump in precious metals. And any smart investors who doesn't believe that the world can live off monopoly money, as we've experienced the last 9 years, but by most central banks printing money and whatnot. So anyone who's a bit skeptical about our monetary policies, experimental monetary policies over the last 10 years, would have to be a bit concerned that at some point, if there's an accident happening, what's next? There's a lot less ammunition nowadays for central banks. We are in a low interest rate environment. We have an enormous debt load from private households, corporates and governments all around the globe. So we're extremely badly exposed. So we really think when it comes to gold and silver, look, it is in a moment looking rather ugly, and to us, we wouldn't be surprised to see gold, nipping 1,100 or even 1,000 again. But to us, really, on a very big picture, that could be an extreme opportune period. It is hurting, but we're not in love with gold and silver, as some people make us look. We basically just believe it is one of the biggest store of wealth in history of the world, and just because we've got Bitcoin around doesn't make it just go away. It is basically unique, and it will have, in our view, a role in a future world currency to play, as for example the SDR, the special drawing rights from the IMF do show that have a major component in precious metals. And why that is, people have to ask themselves, because obviously it always has been a serious store of wealth. So essentially it is something that people really have to look at it real hard from here onwards, and put 10% of their spare cash into it.
Okay. Just finally, you mentioned Turkey, you mentioned emerging markets. From what you're hearing, the people you speak to, how much of how much fear or how much stock is being placed on the potential of a major disruption caused by what's happening in Turkey at the moment?
Well, that's a very fair question. I mean, really, if you go back the last 40 years, every decade, when we had any major hiccup, let alone the Western world going into recession, you go back in history, it was always preceded 6, 12 or 18 months before by an emerging market crisis. Basically, the emerging market is like if you look in investment terms, you have your conservative investments and your spec investments. Well, the emerging market is your speculative part of the game in terms of an economic macro outlook. And obviously, again, they loaded up on US dollar debt, or low interest rates, obviously attracted to that, exposed themselves again to a rising US dollar. It's the same old story. You can go back to the 70s, 80s, 90s, the same thing all over again. So, and that always, historically, precedes major turmoil in the globe. And I said in January, we believe world asset prices are topping this year, maybe the latest first, second quarter next year. And we think this is a macro top. This is a big, big top coming up. We think valuations are beyond the imaginable. It's madness out there. And we got accustomed to this madness. That doesn't mean it's not madness. It still is madness in our view. So the emerging market now is starting to crack on their own madness. I mean, many self-induced. If you look at Brazil or Argentina or Turkey or Russia, there's a lot of self-induced underlying domestic issues that led to this scenario, South Africa, for example. But nevertheless, it does show, or let me say it that way, it tends to have historically an effect to infect the greater part of the world down the track.
All right, Markus Helsing, got to leave it there. Thank you for joining us.
Thanks, James.
We need to take a break here on Trading Day. When we come back, we're going to talk ETFs and global market volatility, so stick around.